And good morning, everyone. Welcome to our webinar for a Wednesday. I'm Randy Price. We are the Price Group, and today we're going to be talking about the retirement planning timeline. A lot of songs and sayings that go with time, but we hope that your time is well spent here as we attempt to share some experience, some perspective, as well as some recommendations that will be helpful for you as far as looking down the road for retirement. If you do have questions, please type those in. We'll try to get to those at the end of the session. Our goal here is 35 to 40 minutes and leaving plenty of time for questions. Who are we? We are a fiduciary-centric firm, Randy Price and Matt Price. We're passionate about the need for a wealth coach. We do work in the retirement area. About 90% or more of our clients that we have been blessed to work with are either near retirement or at retirement. So we feel that this is very important. If you need a doctor that works on hearts, you want a doctor that works on hearts Monday, Tuesday, Wednesday, Thursday, and Friday, not just on Tuesday afternoon if they have any.
A little bit about our firm, Steward Partners, based off the biblical definition of stewardship. We use Raymond James as one of our back offices. They're our custodian where client assets are held. We think there's a salient difference with someone who works for a registered investment advisory firm, somewhere where we can look at a client's situation with a fiduciary mindset opposed to a brokerage house. So we love hanging out at Steward Partners, help serve clients, provide advice through our registered investment advisory firm, Steward Partners, just based off the fact that we're not owned by a bank, not owned by a brokerage firm, and we think that really matters from a fiduciary standpoint. So, should you listen to these two knuckleheads? Randy's humble, so I'll brag on his behalf. We've been honored to be mentioned by Barron's, Forbes, Financial Times in the past. Both Randy and myself are certified financial planners. We both went to the Wharton School of Business to get our CIMA, our Certified Investment Management Analyst designation. If you receive our emails, you've probably seen our Wealth Coach podcast. We'll be looking to publish some more content on the video front here starting this summer, so keep an eye out for that. But we view ourselves as teachers and educators. So we work hard with some of our written literature to try to educate investors as they do approach or enter into retirement.
So let's look at today's agenda. We're going to talk about retirement planning if you're 2 to 5 years out. We're going to talk about retirement planning less than 1 year out. And then we're going to talk about planning after retirement. So let's go ahead and get started. Retirement planning 2 to 5 years out. The old joke is sometimes, many times in Houston, if you're related to the energy business, you're not exactly sure when you're 2 to 5 years out. But our number one step is look before you leap. We think everyone, and we would underline everyone, needs to create a wealth and an investment plan related to retirement. We're going to talk about what a family index number is, but you and your family need one. Evaluate your retirement plan contributions and allocations. Lots of times, perhaps this could be you, but we see people that are, quote, conservative investors, and they have, 60, 70, 80, 90% all in a company stock because they've gotten comfortable, they've fallen in love with that company stock. Consider the consequences, and this is a big one, of a negative year in the stock market and the effect it would have on your retirement date and also your standard of living. So if you're a conservative investor, we don't want to see your 401k be 100% invested in stocks, and all of a sudden we have another COVID year, all of a sudden we have another 2008, all of a sudden we go into more geopolitical consequences that causes the market to go the opposite direction that you want it to go. And number 5, also we think very important, consider hiring a qualified advisor who specializes in retirement planning. We're going to talk about some of the things that make planning during retirement very different than planning during the accumulation phase. And we want you to understand that And again, kick the tires, invest your time before you invest your money. So, is your spreadsheet adequate during retirement? Matt and I have seen a lot of very good spreadsheets during our number of years. I think back to one gentleman who literally took the whole table in the conference room, and I mean, the type was so small, we almost had to have a magnifying glass, and he had spent hours and hours on this. But spreadsheets are better than nothing, but let's take a look at this and show you the inadequacies of a spreadsheet. So you got 4 boxes. We're going to take the upper left-hand box. You've got 10 years. You're going to start with $100,000. Your average return is going to be 7%, and you're going to factor in 3% inflation. Now, we're going to factor in starting off with a negative 15% year, several 7% sort of boring years in the middle, if you will, and then a 29% positive return on the bottom in year 10. What you see is, again, we start with $100,000, you end with $188,399. Congratulations. Now, we're going to flip year 1 and year 10, the sequence of returns. We're going to take the positive year, 29% in year 1. We're going to take the negative 15% year in year 10. And what we see is flipping the sequence of return has absolutely no effect when you're in the accumulation phase. Now think about this. You're in the accumulation phase in your 20s, your 30s, your 40s, your 50s. And if you're retiring, perhaps in your 60s, you're just getting ready to turn the corner out of the accumulation phase into the phase where you start taking withdrawals. Okay, so let's take that same scenario, negative 15%, 7%, 7%, 7%, 29% positive return in year 10. And what we find is you've run out of money somewhere in between year 9 and year 10. Why? Because you had a bad sequence of returns. You started off with a negative year during your first year of retirement. Now, go to the bottom right-hand box. Again, same thing, except we're going to start out with a 29% positive rate of return in year 1, and you see you still have $52,749 at year 10. So this is a brief example that sequence of returns is very important and can have a underlying dramatic effect on returns when you're in the distribution phase. Now, when you factor in higher rates of return, when you factor in more inflation, it gets even more dramatic, but hopefully this makes the case that you need to have more than a spreadsheet to get ready for retirement. So we hear people talk about, well, I'll call my investment guy or whatever. We think you need more than just an investment guy. We would say you need a wealth coach. Think about what's happening this week. The most significant golf tournament is being held in Augusta, the Masters, and most every one of those professionals who makes their living swinging a golf club has a swing coach. They probably have a health coach, a swing coach, etc. But we think you need more than an investment guy. You need a wealth coach. Benjamin Graham, who was the mentor of Warren Buffett, said the best way to measure your investing success is not by whether you're beating the market, but by whether you put in place a financial plan and a behavioral discipline that's likely to get you where you want to go. So we talk about holistic financial planning, tax planning, retirement planning, investments, yes, very important, insurance, cash flow, estate planning, goals and objectives, et cetera, et cetera. So you want to make sure that we're looking at every piece of this potential type puzzle to make the best decisions for our clients. So we do think everybody needs a wealth coach.
So what should a retirement plan include? We are firm believers retirement is not an event, it's an ongoing process, and if you don't have a plan written down, we don't think it's actually a meaningful plan. So retirement roadmap, we call ours a live well plan. We call it that because we're a little bit cheesy, but we really want our clients to live well. And this draws on what Randy was saying on a holistic plan. So we're trying to take every facet of your financial life and pull it in together into this plan. So how much can you spend in retirement? How long will your money last? What rate of return do you need? Our goal, unless people would tell us otherwise, is we want to take the least amount of risk for you to be quote-unquote successful. And success is different for each and every family or individual investor, but we tailor it around what that individual or that family does need or want in retirement. So we think that is a big component of it. Another factor within that Live Well plan, the family index number. What rate of return do you need to obtain quote-unquote success? And so this is a personalized number. We think that's really important. This is one of the ways we try to take the noise out of investing. Randy likes to say his grandmother always said it's always something out there in the world, and that's true as far as the wall of worry, we like to look at it as, where there's always something to worry about, whether you're a stock investor, a bond investor, or a combination of them both. But our goal with the family index number is to create a rate of return that you need on average over a market cycle. Market cycles tend to last anywhere from 10 to 15 years. This is by no means something that caps you out, but at the same time, it's not a guarantee either. We want this to be an average. Some years will be ahead, some years will be behind. Maybe one year we're right on top of it, but it helps us plan for what type of portfolio do you need in retirement. So could be, you could argue, a little bit up in the clouds, generic. Let's look at a very specific and tangible thing that you can do as you are preparing for retirement 2 to 5 years out. This is the backdoor IRA contribution into a Roth, and it looks like this could be eliminated at the end of last year, but as of right now, this is still something you can do. But you make a contribution to a traditional IRA. That contribution is non-deductible, meaning it does not show up as an itemized deduction on your tax return. You do that, let's say on a Monday, you put in $6,000. On Tuesday, you convert that $6,000 into a Roth IRA. Now, the gain on the conversion would be taxable, but you put in $6,000 yesterday, you convert $6,000 today, there's no gain on that conversion, and so it is a backdoor way to get money into a Roth IRA if you are up and above the income phase-outs, which are a lot of people we talk to are above those income phase-out levels. The place you can stub your toe here is looking out for that pro rata rule. So if you have a pre-tax or just a traditional IRA, you have to take those accounts into account as well. So it's not we can just do it on this one piece when you have other IRAs out there. So there's a few kind of metrics to make sure to look at on there, but we're very familiar with that. Be happy to take a look at your personal situation to see if it makes sense. The second idea we just wanted to throw out there, it's probably the first cousin of the Roth IRA conversion. It's the backdoor Roth 401k contribution. So you can make a contribution to the after-tax portion of your 401k, which is different than the Roth 401k. And then you can once a year convert those funds into your Roth account. Not all 401k plans offer an after-tax option, but a majority of them do. And this would be more of a supercharged way to add money into the Roth portion of your 401k. Something else we want to do when you're 2 to 5 years out from retirement is evaluate your investment risk budget. This picture here, it's a few years dated, but it paints what we think is a really good picture. The purple line there, we're looking from 2000 to the end of 2015. A lot of people will refer from 2000 to 2010 as the lost decade in stocks. These stocks went lower, they went higher, they went lower, and they went higher. But The green line is what if you only took half of the downside, but in that same token, you only got half of the upside. You would see that you outperform the overall market when taking half of the risk, and we think that's worthy of consideration when you are getting close to retirement. If you're only 2 to 5 years out, sometimes you don't have the runway to make up after an entire market correction, and we think now is the time to start considering reducing quote-unquote risk inside of a portfolio.
Talked a little bit about the advantages of talking to an advisory team that specializes in retirement planning. Everybody needs a wealth coach. What goes into that? Well, emotions matter quite a bit when you're investing. Mistakes become more costly as you approach retirement. Think about that. You're dealing with a larger amount of monies, and you don't have as long, as Matt just said, to make up in case the market goes against you during that time. Stress level is improved. More investment options when talking with an advisor. That could be alternative investment strategies for additional income, individual bonds to mitigate the effects of rising interest rates. And then the average investor is underperformed. Perhaps if you recognize the name Peter Lynch, he was the manager of what was one time one of the largest mutual funds in the world, and he wrote a book called Beating the Street. And he was doing a press conference one day, and he said, "I'm going to take some questions." And a young reporter raised his hand, and he said, "Mr. Lynch, what is one of your what is the things that you wish you could have changed going back?" And he was expecting, well, I should have bought more energy stocks before this time period, or I missed this one stock that everybody was saying was good and I didn't invest in. And he says, "Oh, that's a great question, and I'll answer that very quickly. It's actually an easy question." He said, "The average investor in my fund came nowhere close to the average return of my fund." And the reporter was somewhat stumped, and he went on to explain that every mutual fund can track the average return of investors, and they can track when that investor put money in, dollar cost averaging through their 401k or their reallocation toward summer, fall, spring, and again, the average investor was very good at buying high and selling low. So that was his biggest regret, was not having his average investor earn the very good return that was in his fund. So that's 2 to 5 years out. As we move forward, we're going to change gears here and go to retirement planning less than 1 year out. It's getting exciting. You're thinking about what your plans are, what are you going to do in a little bit more detail. But we need to estimate in greater clarity your retirement income needs, variable expenses, fixed expenses. You're going to put a new roof on. We're going to take that special vacation. You're going to buy some land outside of town to build a house. Let's start looking at the pension versus the lump sum. If you're fortunate enough to have a defined benefit plan where that is an option. Are you under 59.5 versus over 59.5? The planning is different there. Create your retirement income strategy. Not just wing it, not just hope. Those are not strategies, but create a strategy on paper, as we've talked about, where we show you each year where you're going to get how much money. You're going to monitor your retirement plan discount rate. Again, assuming that you've got a defined benefit pension plan. We're going to evaluate your ordinary income and capital gain income tax rates, very important. And as we've talked about, consider hiring a qualified and making sure they're a fiduciary-centric advisor team to help you with that. So income needs in retirement. We're starting to see a little bit of what we've been talking about for years: inflation, the hidden tax. Wow, what happens when energy prices go up? Things at the grocery store go up. Things go up all over the place. So what happens if inflation is more during your retirement than you've anticipated or planned for. Again, hopefully you planned for something. We kid and say the bank of mom and dad is always open if you have children. It's open nights, it's open weekends, it's open holidays. And so, what big ticket items, typically automobiles, a roof, some home remodeling, repair, travel. Some people have, a whole bucket list of destinations they want to go. You've got ongoing fixed and variable expenses. You may be wanting to make gifts to family or charity, but from a standpoint of that, we think 70 to 80% of your final salary is what you need to look at as far as your income needs during retirement.
So is 3% the new 4%? Pretty catchy slogan, if we may say so ourselves. We didn't come up with it. It's been in a number of research papers here over the past few years. But for those of you that might not be familiar, the 4% rule has dated back for decades and decades. And it's the adage you can take 4% out of a balanced retirement portfolio, get a raise on a regular and consistent basis, and have the confidence that you're not going to run out of money in retirement. But this study, the 4% rule study, was done in the 70s, the 80s, the 90s, into the early 2000s. And during that time period, interest rates were a whole lot higher. So the non-stock piece of your portfolio was generating a lot more income. Now, with interest rates being low, we've seen them move noticeably higher this year, but still on a historic basis, very low. We're asking the question, is 3% the new 4%? And that's not because we're stingy, not wanting clients to spend their hard-earned money in retirement, but we think there's a valuable or a worthy consideration that taking 3% out could be the new 4%, just based off the fact interest rates remain rather low.
Matt, I'm reminded of that client that asked us, well, it's just 1%, and we went on to explain that 1% increase from 3% to 4% is actually a 33.3% increase in your distribution rate or your income needs. So if you're fortunate enough to have a company pension plan and you're dealing with the decision whether to take a monthly annuity or the lump sum, the pros of the company pension: income for life, company takes the investment risk, you do have limited flexibility, your purchasing power is obviously diminished by inflation, you have the risk of the company and whether that defined benefit pension plan has the assets to continue. Again, your questions would be single and joint options, period certain options, how long will you live, do you have assets outside of the retirement plan, making large purchases, and what are the non-company annuity alternatives. On the lump sum, flexibility, potential inheritance for your heirs, inflation protection, estate planning flexibility. On the negative side, you can spend through that capital if you don't have a plan. Do you have an investment process? Do you have potential inheritance that you'd like to leave for your heirs? What is your break-even point when comparing the lump sum and the company pension? We go through all this. What's your outlook for interest rates, and where is the outlook for interest rates and inflation? So anyway, all things that need to be looked at, and certainly part of the planning process that we go through for clients. So for early retirement, pre-59 and a half, how do you get money? Well, sometimes we take a one-time distribution. Sometimes we use a special code section of the Internal Revenue Code to take money out over 5 years without paying a 10% penalty tax. Sometimes we use what we call NUA, which is taking stock out at cost and paying capital gains tax on the appreciation. People will sometimes borrow to meet, if you retire at 58 and a half to get to that year to your 59 and a half. Some people might go back to work, do some consulting, or sell some after-tax assets. So there's a lot of ways to skin the proverbial cat, but again, each situation is different. You and your next-door neighbor may be exactly the same age, but have much different circumstances that would necessitate a much different plan. So personalization is the big key by talking to a group who understands how to make income during retirement?
We think dividend income in retirement is really, did I say really important? Here's a look back, dating back to the early 1940s. The dark or the royal blue portion on each bar represents the dividend contribution to the total return being the dividends plus the appreciation or less the depreciation for that decade. And as you can see, over a long period, dividends equate to 41% of the total return of the stock market. So that is not an insignificant amount. We think that's very important while you're working, but even more so in retirement. From a standpoint, you need income from the portfolio in retirement, and we think one of the best ways to do that is own dividend-paying stocks.
So a lot of people will talk about, when I get to retirement, I'm going to sell a bunch of my stocks, and I'm going to invest in CDs, fixed income, safe bonds, and we put safe in quotes. Let's go back and look historically at three periods of time, 1920 to 1940. During that time, again, the real rate of return, which is the return after inflation. So if you had 2% inflation and you got a 6.4% real rate of return, that means you were really getting 8.4%. So during the 1920s, 1940s, you made a very nice living by investing your money in bonds issued by the U.S. government, T-bills, T-notes, etc. You can see the difference there, and voila, great retirement. The war started. Second World War started in 1941. We had inflation. So for the next 40 years, notice an extended period of time, you saw after inflation, unless you owned some stocks, you had a negative real rate of return on Treasury notes and also Treasury bills. Even though, remember during that time, during the 70s, we saw some very high interest rates, but inflation was also very high. 1982, another period through 2009, an extended period with low inflation. So again, the person that owned safe bonds did very well. And you say, well, okay, period number one, period number two, period number three, that's interesting, Matt, that's interesting, Randy, but tell me about the future, door number four. And wow, yeah, that's the salient, the key question here as far as going forward. We think there's going to be some inflation. We think that you ought to own some stocks. And the amount of stocks you own sort of depends on your situation and circumstances, and that's one of the questions that we sit down and help people figure out. So one of the big mistakes that investors will make is investing without a process. What is your investing process? Well, I saw something on the news. I talked to someone at work. Someone told me a stock was going to be a good buy. Let's look historically. And again, this is a period of highs and lows in the stock market. So a little bit of a busy chart, but I think very helpful. So you're going to see the lighter green are the flows into equity mutual funds. This is measured, and so you can see that people were putting money into the stock or equity mutual funds, and it reached a high there. Right about 2000 and 2001. People were putting money in, and the S&P 500 performance just happened to be high at that point. The S&P 500 performance, the 500 largest stocks, is that dark green line. So the circle shows people put a lot of money in. They were buying when the stock market was high. Conversely, let your eye move to the second circle there on the right in 2008, and what happened? The stock market took a big fall, okay? And what happened to the people putting money into the stock mutual funds? It literally dried up overnight. People were taking money out, and where were people investing that same money? They were switching money from stock mutual funds to bond mutual funds. So think about this. Stocks went on sale, and people sold all the stocks. Very contrary to the philosophy that you would have. If you go to Walmart, or you go to Target, or you go to Costco, or you go to the grocery store, and they've got butter, or they've got pimento cheese, or they've got soap, whatever you're buying on sale, what happens? You typically buy more of it because it's a better bargain at that point in time. In 2008, the great financial crisis as it's called, stocks went on sale, and people said, no, I don't want any part of that. I'm going to sell them. I'm going to put myself into bonds. Was it a scary time period? Yes. Was there a lot of emotion? Yes. Was there a lot of uncertainty? Yes. But again, those who had their investment process thought twice about making wholesale radical changes in their investment portfolio, because our clients, we had focused on income. And if you have income, you can take care of the market fluctuations during retirement. Our joke is if there's fluctuations in the portfolio and the mom and dad, our clients, have enough income, it's the kids, the grandkids' problem if it's worth any less. So again, interesting picture, and the takeaway from this is everyone needs an investment process. Why? How much can you spend in retirement? How do you invest your portfolio to meet your needs? Most investors make poor financial decisions, sort of as we talked about, during stressful periods. It's been proven by the experts in measuring the part of the brain, letting emotions get in the way of logic and reason. Discipline and income generation. We're all about discipline. We're all about income generation. There are core principles of our process-driven investment strategy. We want to help you protect your assets while generating the level of income and also growth that you need to meet your objectives with the minimum risk. So again, this is all taken into account and again, part of the investment process that everybody needs to have.
So let's spend a few minutes looking at the planning after retirement. We think something that we should do for clients on a regular reoccurring basis is stress test your portfolio. And intuition might tell us that if your portfolio is down 20%, well, I only need 20% to get back to break even. And in retirement, that is not necessarily the case. So let's look at someone who's taking 5% out of their retirement portfolio, and there's a 20% pullback with their overall portfolio. This assumes the withdrawal. This assumes an average long-term inflation rate of 3%. But with a 20% pullback, you don't need 20% to get back to break even. You need 37% just to get back to break even. So we think the winners in retirement are the ones that can prevent themselves from being losers in a down market. And that goes back to dividend stocks. Dividend stocks, on average, have less risk than the overall stock market. We think that's important, not to mention, like we've already talked about, the fact that they're producing regular, reoccurring, and hopefully increasing income year over year.
So a few planning ideas, perhaps be of help to you. Consider holding your assets that would generate taxable income in qualified accounts, if you will, IRA accounts. Most people are aware of the new rules where if you're 70 years or older, you can take money out of your IRA and give it to a charity, and it counts towards your required minimum distribution. Great thing to cut down on your taxes. Some people like giving appreciated stocks. You bought a stock at $10 and it's at $50. You can give that $50 stock away and get credit for it, and nobody ever pays the $40 of capital appreciation that has occurred. Where do you take distributions for retirement? Lots of times we have clients who will take some out of a taxable account, some out of an IRA, maybe sell some stocks, etc. Roth conversions have been a topic of great interest. Do you need to take some IRA distributions prior to when your required minimum distributions, which are now age 72, will begin? There's a law pending now for that to increase now to age 75, so this tax planning is going to become even more complicated and important. But your planning in retirement should be a process, as we've said. Your planning in retirement should be benchmarked against your specific goals. And again, that's exactly what we do, sitting down, making sure that you're aware of where you are and also where you're going.
We'd be happy to put together a Live Well plan on a complimentary basis. Our goal with that, to provide the 3 C's, comfort, confidence, and clarity. At the very least, we think you leave this exercise a more educated consumer. We don't, in this meeting, sell anything. We don't have an agenda. We're very transparent with what our cost structure is, but our goal is to educate, like we said earlier, and we think this is a real good way for you to possibly kick the tires, and at the same time, us kick the tires as well to see if it's a good fit.
So you said, okay, what should I ask when I interview an advisor or an advisor team? Do they follow the fiduciary standard? You know, if you work for certain institutions, it's very, very difficult, if not impossible, to be a true fiduciary. You go to a lot of people and you don't understand, even after talking to them, what the cost structure is. Believe me, believe Matt, there are costs associated, and our goal is to spell out in a transparent manner what the cost structure is. Experience, big deal, whether you're having heart surgery or your knee worked on, or whether you're looking at hiring a wealth coach. Are they a certified financial planner? Do they have their certified investment management analyst? What sort of experience? Do you have an individual or team supporting you? So we've talked about, we think you need to work with a team that works primarily with retirement, if that is your main goal in mind. You matter to the price group. We have a personalized retirement plan for everybody that we talk to. It's not a cookie cutter strategy or approach. We have a low client to advisor ratio, which we think is really important. We feel like we communicate both in a written format as well as in regular meetings well. You want somebody that can speak in a manner you can understand. Matt has talked about the plan needs to be written. It needs to be holistic. We try to anticipate your needs and make sure there's systematic outbound communication. So if you'd like to see a little bit more detail on this, our complimentary guide, 10 questions you should ask your financial planner, then certainly come back to us with an email, and we can take care of that. Matt, questions so far?
No questions as of yet, but if you do, shoot Randy an email, myself an email, or we're also happy to speak over the phone if it's too laborious to type out a long question. But yeah, thank you all for coming. We certainly appreciate it. Here, picture of our team: Randy, myself, the rest of the team, Maddie, Tiffany, and Melissa, and we are here if you need us.
Have a great rest of the day, and again, our sincere appreciation for you taking time out, and hope to talk to you soon. Bye-bye.